Hello, welcome again, Tavi Costa, here at Citywire. Tavi, it's a pleasure to have you again with us.
Thanks for having me, Andreas. Looking forward to this.
Great. So a lot happened since the last time we spoke. Energy prices skyrocketed, especially electricity, natural gas prices, but also commodities in general had run once again. So how's the situation on the whole commodity complex?
Well, we're in a box. Any soft tone from the Federal Reserve is going to probably reignite this inflationary narrative because most of the long-term problems we have in the commodity space have not been resolved. The CapExes, the long-term CapEx trends for most of the producers and developers and explorers are still in the dumps, and they have not gone anywhere higher from their historical lows. And so that's the big question. We haven't changed any of that, and therefore any sort of more dovish tone from the Federal Reserve or any other central bank will probably drive this much higher. We've got the pillars of inflation still really strong, impacting inflation. The wages and salaries growth continues. We still have the supply problem. We still have the reckless fiscal spending. And unfortunately, we still have the geopolitical issues still heating up. And so the combination of all those are still very strong tailwinds for the natural resource industries, and it's incredible to see nat gas, especially. It's probably one of the most important developments happening right now, and not just in Europe but in the U.S. Natural gas prices making new highs recently looks to me like a roadmap for the majority of commodities here.
But that's very interesting when we see these commodity prices, as you mentioned, still being elevated and even rising ever more. Inflation will be very sticky. So in contrast to what Jerome Powell said some time ago, or I don't know why he said it, it's quite unlikely that the central banks can put a brake on interest rate hikes. Or what's your view on that?
It's hard to me to believe that, for instance, when you look at the Eurodollar curve, that they're expecting rates to be cut. I'm just not in that camp at all. I don't think that we're going to see interest rate cuts in the next 6 months or so, like the Eurodollar curve shows right now. And so I think that may surprise equity markets to the downside, meaning if you got that tightening staying for longer, I don't think that that's necessarily positive for equity markets. And it's interesting that the investors are not really trusting this narrative at all, and therefore why we're seeing this inversion in the Eurodollar curve, pricing in already the very high probability of a rate cut. Again, I'm not in that camp. I think that those probabilities are going to fade. I think those probabilities are going to change over time. And that's going to be negative. And so we're kind of in that box. Well, a softer tone causes commodities to rise again and creates inflation for the next 3 months or so. And you have yields moving higher, which is precisely what we're seeing right now. 10-year yields are back to 3.11 or 10%. That's a big deal. I mean, how do you justify this run in equity markets being sustainable and not a bear market rally when you have 10-year yields spiking the way it is? And 10-year yields are acting like natural gas prices right now, as far as the trajectory of the price, not the steepness of the move. And so meaning nat gas has made new highs or recent highs. And so you would think that 10-year yields could do the same, and then oil could do the same. And then you have this cascade effect, and you have agricultural commodities starting to move. Look at cotton prices, look at corn prices, look at coffee prices. And so, you get natural gas prices going higher, then you have ammonia, then you have agricultural, then you have food. And so it's all linked. And oil is looking very bullish too. It's breaking out from a downward trend, a recent downward trend. You have the E&Ps, the oil companies already leading the way to the upside. Look at fertilizer stocks. They're all making very near new highs. I mean, if you look at CF Industries, that is actually at a new high right now. Put that chart along with ammonia prices. What do you have, right? It's telling you ammonia prices are probably going to make new highs too. So it's really interesting.
I totally agree. And we had some companies reporting today and yesterday stopping their production of ammonia because of the high natural gas prices. So we are in a kind of really vicious circle regarding these input costs, and let's say electricity costs also a big drag here in Europe for corporates, and this will be rolled over only over the next weeks, months, and quarters because the bills haven't been sent out yet. Prices are high, but they are still calculating also consumers. We didn't get the bills yet. This will only be visible over the next weeks and months. So it's a kind of stagflation scenario or where we live in, no?
Of course, I think this is shaping up to be a vicious stagflationary environment. And what is the solution that policymakers are taking? Tightening monetary conditions? How's that going to help? I don't understand how you're going to help a producer. What we need is a lending facility ready to help most of the producing companies of natural resources in the US in order to increase supply of everything. But if we're not making those actions or taking those actions today, it's not going to happen in 5 years from now, because you're lucky if you get a new discovery into production in 7 years today, especially in the mining space. And so I don't think policymakers are really considering all those imbalances. And so I'm in the camp inflation is going to stay here for longer. I think this is the beginning of an inflationary regime. I've been in that camp for some time now. We're going to see some waves, but look, market leadership will not be what it was 10 years ago. I mean, I'm very confident that it's not going to be the case. The technology companies and so forth, mega cap, how does that change? The macro environment is going to be a big question, and I have my potential scenario kind of answers, and I don't think mega cap technology companies are going to be leading the way anymore.
And there's another component, the US dollar. Looking at the US dollar versus the Chinese yuan, this looks interesting as well. So there's a hell of devaluation of currencies versus the dollar, and the US is exporting its dollar problems around the globe. So how does this fit into the whole macro scene?
Well, that's a very good point, right? Because you have the dollar strengthening, you have the government selling 30 million barrels per month of their strategic petroleum reserves. You have China in a balance sheet recession, and oil is staying around $90 to $100 a barrel. This is crazy. That's how tight this market really is. And to your question, if there's a scenario that I think the setup could be completely wrong, is a scenario where there's a major devaluation of the yuan. I am a believer of that. I think there is a potential for that. So what I do, people maybe think, well, you're talking both sides of your trade. No, not really. I am long commodities, and I have a very large short exposure to the Chinese currency. Both may actually happen together, meaning commodities may rise with the Chinese yuan devaluing over time, but it's not necessarily how I think it's going to play out. I think there's a chance for a steep devaluation of the yuan to catch up with most of its leading indicators, regardless if it is interest rate spreads between US and China, with the US tightening and China easing, or you have the required reserve ratio banks, which it's still very it's been declining over time. Also trends very closely with the CNY versus the USD, and so all those are important macro divergences that I think could lead to a much bigger move. And remember, back in 1994 or 93, 94, when China devalued its currency in order to restructure their banking system at the time, we saw a 50% devaluation of the Chinese yuan. That is unthinkable today, right? I don't think anyone believes that could happen in a day like today. Well, I'm not saying we will see that, but I like those odds. I look at the situation, I think is way worse than what we saw in 93, 94. It's way over levered compared to those times. We have a real estate problem. We have a political issue in China. We have a geopolitical situation with Taiwan. And so it's hard to believe the scenario in terms of probabilities is not even greater than it was in 93, 94. While you look at the implied volatility is what, 6% at the highest. I think those odds are really, really interesting for a macro trader. This is as good as it gets.
That's exactly the point. The macro outlook, it looks bleak at the end of the day. Housing in the US is already in a severe situation. China is growing at 3 to 4% only. If we had China growing at these rates some years ago, the world of equities would have been shocked. Still, equity markets are quite reluctant or resilient. What's your take? Is it just a bear market rally and we will see a continuous downtrend over the next 6 to 12 months again?
Yeah, I think that's a function of positioning. To me, it has been a good hedge to our inflation trade. So we have lots of long commodity positions in our portfolio. Therefore, I like to hedge that by being short equity markets. And I've been saying this for a few years now. I think that portfolio has worked really well. And it's been, I think we're going to be in that environment for much longer than most people believe. It's the growth to value idea, buying producers that actually make money, that are profitable, that pay higher dividends than most companies in the S&P 500 today, versus most of those growth stocks that still have very high multiples that we think it's completely unsustainable. And so to me, that's just a smart trade. If we have, let's say, higher CPI prints, which would make the Fed have to become even more hawkish, we might see a sell-off even in commodities in an environment like that, believe it or not, just because of that hawkish tone kind of expectation. But it would be very, very negative for equity markets, in my view. And so I like to have that as a trade. I think there's a lot of interesting plays here in the markets, but this commodities to equity ratio is one of the most important ones. And then you add this hedge of the Chinese currency. I think this is probably one of the most attractive portfolio positions for most people, in my view.
Looking at the Chinese yuan again, so a devaluation or a significant devaluation of that currency would be a kind of risk-off event, wouldn't it?
I think so. I think it would hurt. Let's just think about the portfolio I just said. I think it would have probably hurt some of the cyclical commodities. Hard to believe oil wouldn't be down on that day. Hard to believe copper wouldn't be down on a day like that. Gold, jury is still out. There were days back with the devaluation of the yuan that a lot of people thought gold would fall apart, and actually gold did quite well, along with the dollar doing well. And so, or at least held up its ground very, very well. Treasuries could be in a tough situation because of that too. And I think equity markets is probably one way to play it too. I am not, so we're at Crescat, we're not short the Chinese equities. We were in the past, and it's just we are much bigger believers of further dilution of the currency rather than playing the equity side. I think the Chinese currency really is the main driver of most of those issues, and will be one of the ways where they can use it to hopefully not cause too deep of a problem. But I think it's inevitable that we're going to see the Chinese currency devalue relative to the dollar. It will create a risk-off setup.
In former times, it was like when a certain asset moved extraordinarily, or there was high volatility in a certain segment, it had knock-on effects nobody was thinking about, and it had major implications. Now we have this kind of situation in many parts of the asset market, either equities or currencies, commodities. So there must be casualties over the coming months.
Well, I just can't think of how this is a bullish setup for equities when you have PMIs at the levels that we saw in the global financial crisis that came out yesterday, or or so. And on top of it, you have the Fed now, which I don't think it's getting enough press. The Fed is going to start selling almost $100 billion, or no, I shouldn't say selling it, reducing its balance sheet. It's a runoff dynamic. And so they're going to let those securities mature. So they're going to reduce their balance sheet by almost 100 billion. So it's $90 billion per month starting next month. And so, I mean, you look at the change, the monthly change of that over history, this is a very significant amount. It's hard to believe that's going to be positive for equity markets when you're already seeing not only this deceleration in most metrics, but a downturn in metrics like PMIs already down significantly. So you're adding that tightening conditions, monetary conditions on top of the downturn of the economy in most economic activity gauges. I just don't think this is positive at all for equity markets. So folks calling for a new bull market, a blow off top, it's just not in my setup right now. I mean, it's just not, and I can't believe that that's going to be the next play here. So I'm just focused on the other side of all this. I think we'll continue to see the relative performance of tangible assets relative to financial assets continue to go to the upside. And I keep thinking about what's the best way to play this. And I think commodities is just one way to do it. We do mostly in explorers because the odds are not there either. And we're talking about odds and implied volatility versus what history tells us and what the real probabilities perhaps are much higher than those implied vols. Well, the same thing is happening in exploration companies that are, you're basically seeing companies that have very high probability with discoveries that are priced as they don't have anything. And so that's kind of interesting. And so that's, to me, those are the inefficiencies that attract me as an investor.
Great. Thank you, Tavi. It was great to have you again with us. Interesting views and thoughts, and let's catch up the next time again. So let's see how markets will behave over the next 6 to 12 months. I think it will be a tough environment, as you mentioned. Thank you very much.